This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of September 20th, 2021, a week that began with all sorts of concern over China, debt, and the situation with a company called Evergrande. Would it become a global contagion similar to what we had in 2008? Well, maybe, maybe not. But on Monday, they were on multiple occasions, even dropping below, but immediately recovering. We noticed that on Monday and began to project a rally once again by later in the week. Anyway, okay, so here's the thing to watch. Here's that chart, daily S&P 500. Coming out of July 2020. It was in about April or May that after the COVID smash of March, we got back above the 50-day moving average. You can see in July and August, well above it. Then you come down at the end of August, okay? See how it's kind of running along in the middle of August, running along that 50-day, and then it drops below it and then plunges below it with like a little hammer thingy. It spends 5 days fiddling around here below the 50-day. Before gapping up, banging into it around the 1st of October and getting back above it. Now, then look though, it didn't make a higher high. Came down, rattled around on the 50-day again at the end of October, and then gapped down. And man, whatever that is, about October 27th or 8th, it looked like, oh boy, are they in trouble. The stock roaches are deep doo-doo. 3,300 S&P. And what had happened? 1, 2, 3, 4 days, 5 days below, gap, 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 gap. And then it did make a new higher high and has been running ever since. Again, 3,300 at a Halloween last year looked like, oh crap. That was about the time right before the U.S. election was Biden was elected and you knew all this cash was going to get created, and look what's happened ever since. Tapping it at the end of January, tapping it actually getting below in early March, tapping it in late March, tapping it a couple times in May, in June, and July, and just continuing higher. Riding it as to now, though, look at what has happened. Kind of like in September and October of last year, riding that 50-day, all days last week, and then gapping down today. Looks almost identical in a sense to late October. 5 days kind of going sideways, and then in October, gap, 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 up. Tuesday was the first day of the September FOMC, so it was a typically pretty quiet day. So in preparation for Wednesday, the Fed lines and Powell's press conference, we took a look at the long-term daily chart and the pattern that has been obviously painted by the bullion banks. Consistently lower highs, maintaining a downtrend, keeping sentiment down, enthusiasm down, and price down for the entirety of 2021 thus far. Gold on the daily chart. I wanted to show you this. I tried to show this in the morning post, but we'll take another stab at it now. Again, this period in the left-hand side. Now, this is daily nearest, so it kind of jumps around a little bit, but this is the daily continuous, daily front month, whatever you want to call it. Notice this is that period in April through June of last year, where gold was in a $100 range. We didn't know which way it was going to go. Bounded roughly by 1680 support, which was tapped for the last time on June the 5th, the BLSBS day of 2020. But then 1780 as resistance. And you can see once we got above there in late June, early July, we kind of consolidated and then wham, just flew out of there. So as we came down, again, you could see then where 1780 was support. And then 1680 was support. Then we got above there in May and June, and then it was supporting it anyway. You get the idea. So it should not come as any surprise at all that 1780 is, again, bank-enforced resistance. You can also see what we've been complaining about. How many times the banks have enforced these series of higher high or lower highs. Okay, from the beginning, back in August of last year, massive red candle to paint the top. Try to come up, start to break out right after the election, massive red candle to paint a lower high. Try to get back up there in early January, massive red candles to keep the string of lower highs and cap price at 1960. comes all the way down, rallies back in April and May, trying to hang in there. Massive red candle in early June and a string of massive red candles with the Juno FOMC, and we're falling again. Try to come up to the next level that we've been watching around 1835. Massive red candles in early August. Came back up there just a couple weeks ago, and again, more massive red candles. You can see this plain as a nose in your face. You can see what their intention is to continue to paint lower highs on the chart to keep sentiment down, keep nobody interested in gold so they can keep price down and, I guess, buy as much physical gold and allocate as much physical gold as they can before January 1st. It's about the only thing I can come up with. Wednesday, September 22nd, brought those Fed lines and Powell's press conference. The initial reaction to the Fed lines at 2 o'clock Eastern was positive. It looked like the Fed was going to postpone any taper plans. But Powell in his press conference made it pretty darn clear that come November, we're going to get a taper schedule that's likely to begin in December. The dollar then spiked and the metals plunged. And it got us thinking that there were probably some lower lows still to come. And you can see this in silver as well. Now, again, 23 was the low and was support in late March. So when we came down there in August, you expected that to be support, and it was. But now that we've been busted below there in the last few days, 23 becomes resistance. And again, today, it was. How about that? If somehow silver can rally from here, stronger commodity market, maybe the dollar doesn't make new highs. Once it gets a foothold above 23, it should go to 23.50 and then 24 in relatively short order. And then it'll run into the 50-day moving average again. It's a possibility. But with the likelihood the dollar is going to rally now with all this taper talk, it's probably more likely that it rolls over. And again, a weekly close below 22 sets up probably a 10% drop in COMEX silver. And again, 10% down since the dollar's rallied a point, 150 points from 92 to 93.5. Silver's gone from 25 to 22. Okay? Or 22.5. Well, down 10%. So another 10%. See how all these dots align? If the dollar does end up going to 94.5, 95. And again, with all this crap that you heard today from Powell, that's probably the most likely scenario. All that selling on Wednesday led to a general liquidation in the precious metals and the mining shares on Thursday as interest rates spiked higher. This realization now that taper is coming is likely to lead to some strength in the dollar, too, in the weeks to come. So we got to start looking at downside targets, unfortunately, in the precious metals. Looks like we could probably expect something down near 1,700 in COMEX gold, something under 22, maybe even 20 in COMEX silver. And the GDX looks bad too, probably falling to somewhere near 26. And the GDX is beginning to foreshadow that. Now, decisively below the old cup breakout level up there, 31.25, 31.50. You can see here the importance of 26. Resistance in 2016, then support in 2016, and then a whole period from the back half of 16 through the first half of 19 where 26 was resistance. Got above there in late 2019. It was then support. Sure looks like that's where we're headed. And again, that's another $4 down from here. That's almost 15% down. So if gold looks like it's going, if the dollar is going to keep going higher and rates are going to keep going higher and real rates are going to, the tip's going to fall some more. Then gold looks like it wants to go to 1680. If gold's going to 1680, then silver's probably not going to hold 22, and it's going to head to 19 something or 20. And if that all happens, then you can see the shares are going to 26, and that's what I am concerned, or that's what I fear is going to be playing out in the weeks to come. And as an important week draws to a close on Friday, September 24th, the precious metals remain under pressure, and that's likely to continue, unfortunately, with Powell making it clear that in the next FOMC meeting in early November, we're likely to get a taper schedule, and it's a taper schedule that probably will begin in December. That means the next 6 weeks we're likely to remain under pressure, maybe not straight down in the precious metals, but more of this slow grind lower. A few up days mixed in, but a grind lower nonetheless. So you must be aware of some downside risk here, mainly driven by the dollar, which is your final chart of the week. As you can see, the dollar going out on Friday near its highest weekly close of the year, up around 93.30. Looks to me like it wants to go to that 94.60, 94.70 level. That's 1.4 points from here. Well, I'll remind you that the dollar's already rallied 1.5 points since early September, and in that rally, silver has fallen $2.50. So there's no reason to think that silver is going to hold up if I'm right about the dollar. Silver likely break down through 22 in the weeks to come and likely head to somewhere between 19.50 and 20. Gold falling likely towards 1,700 and the GDX likely falling toward 26. It's going to be painful. It's not going to be any fun, but also may finally present the last dip that we'll get a chance to buy as we headed deep into the fourth quarter and into 2022, because the macro picture certainly hasn't changed. It's just that for now, the dollar looks better than the euro because the Fed's not printing them at the same fast pace as the ECB is. All part of the remarkable markets we have here in 2021. Thank you for listening to the TF Metals Report podcast highlights. Look forward to having another one of these podcasts for you next week.